This video is brought to you in partnership with Stake. If you're in Australia, transfer at least $1,000 worth of Aussie shares across to the Stake platform and get 12 months of zero brokerage. Stake rewards, terms and conditions apply. In 1999, during the massive market bull run, Warren Buffett wrote this article for Fortune magazine. In it, he said, quote, "I think it's very hard to come up with a persuasive case that equities will, over the next 17 years, perform anything like they've performed in the past 17. Going on to say that if he had to pick the most probable annual return, it would be around 6%, noting that if he was wrong, it'd likely be much lower. At the time, investors were shaking their heads at Buffett, and the consensus of even experienced investors was returns would be over 12% annually for the next 10 years. Buffett was right. Less than a year later, the dot-com bubble burst, the S&P 500 nearly halved, and the actual annual return across the subsequent 17-year period was 2.77%. At the time, Buffett chose not to buy into the hype of the internet stocks, as he could see strong parallels with the aviation and automotive industries he'd studied in the past. Both of those industries, at their respective times, were touted as the next big thing in technology, but despite being massive boons for America, most of the auto and aircraft manufacturers investors could pick from went bankrupt. Around the time of this article, Jeff Bezos, founder and then CEO of Amazon, was enthralled by Buffett's insights, actually asking Buffett for the long list of automakers and aircraft manufacturers that didn't make it. His quote, "When new industries become phenomenons, a lot of investors bet on the wrong companies." Roughly 2 years later, the high-flying internet stocks, including Amazon.com, had all cratered, and Bezos was unfortunately staring at a split-adjusted share price of 30 cents from a pre-crash high of around $4.30. And he was one of the lucky ones. Many online shopping companies, notably Pets.com, Webvan, and Boo.com, as well as several communications companies such as WorldCom, Northpoint Communications, and Global Crossing, failed and shut down. Others like LastMinute.com, MP3.com, and PeopleSound remained through acquisitions, and even larger companies like Cisco and Amazon, for that matter, lost large portions of their market caps. In the case of Cisco, 80%. But Buffett didn't have to crunch the numbers for weeks on end to see this coming. He didn't have to read thousands of pages of mortgage-backed securities filings as Michael Burry did in the mid-2000s. All he did was recognize certain patterns of investor behavior, which time and time again generally lead to problems in equity markets. These patterns of behavior were the subject of Howard Marks' recent memo titled On Bubble Watch, where he notes many similarities between the investing environment we see today and the one in which Warren wrote his famous Fortune article. So what is the backdrop today, and are we looking at another dot-com bubble? Well, like the internet stocks being bid up to the moon in the 1990s, today we're seeing a very similar phenomenon with a different technology, and that of course being artificial intelligence. Specifically, we're seeing the top 7 stocks in the S&P 500, the so-called Magnificent Seven, being bid up to eye-watering valuations, and this is distorting the entire index. On the back of their unbelievable share price gains, the Magnificent Seven now accounts for over 30% of the weight of the S&P 500 index. But as Howard Marks notes, if you rewind just 5 years ago, that share was roughly half what it is today. There's no doubt the S&P 500 is getting extremely top-heavy, and in fact, prior to the emergence of the Magnificent Seven, the highest share for the top 7 stocks in the last 28 years was roughly 22% in the year 2000. At the height of the dot-com bubble. But are the market conditions we see today representative of a stock market bubble like what we saw in 1999? In his memo, Marks notes that while you can look at countless objective measures to prove or disprove your point, in his experience, a bubble is more of a state of mind than a quantitative calculation with 4 key characteristics: highly irrational exuberance, outright adoration of the subject companies or assets and belief that they can't miss, massive fear of being left behind if one fails to participate, FOMO, and the resulting conviction that for these stocks, there is no price too high. This is exactly what we're seeing today in the world of AI stocks. Especially with Trump's inauguration recently, there is a lot of exuberance regarding any business related to artificial intelligence. News outlets are frequently commenting on how companies like Nvidia simply cannot miss. We're seeing lots of everyday people open brokerage accounts to get in on things like US tech and Bitcoin. Stake's most frequently traded stocks right now are Tesla, Nvidia, MicroStrategy, and Palantir. FOMO is in the air, and even by looking at the price to earnings multiples for these Magnificent Seven businesses, you're seeing some numbers above 50, showing that investors now really are committing to the idea that for some of these companies, there is no price too high. Mark's memo is actually scarily similar to Buffett's take on the market in his 1999 article. In it, he said, quote, "Once a bull market gets underway, and once you reach the point where everybody has made money no matter what system he or she followed, a crowd is attracted into the game that is responding not to interest rates and profits, but simply to the fact that it seems a mistake to be out of stocks. In effect, these people superimpose an I can't miss the party factor on top of the fundamental factors that drive the market. Today, staring fixedly back at the road they just traveled, most investors have rosy expectations." And in the next paragraph, he cites a survey from mid-1999 that shows at the time, the least experienced investors, those who had invested for less than 5 years, expected annual returns over the next 10 years of 22.6%, with those who have invested for more than 20 years still expecting 12.9%. The crazy thing is, all in all, they got a negative 20% return in 10 years, excluding dividends. Now, that's not to say that a crash is necessarily around the corner, just that there are most certainly similarities between the general consensus of 1999 and today. And one key similarity that Howard Marks discusses in his memo is newness. Stock market bubbles very frequently form around new technologies or new concepts. Howard notes, quote, "There were bubbles in the Nifty 50 stocks in the 1960s, disk drive companies in the 1980s, TMT/internet stocks in the late 1990s, and subprime mortgage-backed securities in 04 to 06. These relatively recent manias followed in the tradition of ones like the 1630s craze in Holland over recently introduced tulips, and the South Sea bubble in 1720 England concerning the riches that were sure to ensue from a trading monopoly that the Crown had awarded to the South Sea Company." And the reason bubbles generally form around new things is because it's a very common practice in the valuation of stocks and stock markets to look at what's happened in the past to have a measuring stick to assess investing conditions today. If an industry's or a country's securities are attracting unusually high valuations, investors can say things like, well, in the past, those stocks have never sold at more than a 20% premium or something similar. The history, in a way, serves as a psychological tether, which in reality stops things from getting too out of hand. But as Marks notes, if something is new, meaning it has no history, then there's nothing to temper enthusiasm. It has no historical tether. The resulting situation is what we see today. Howard Marks absolutely hits the nail on the head with the analogy of Hans Christian Andersen's The Emperor's New Clothes. In this story, a conman sells the emperor an allegedly gorgeous suit of clothes that only intelligent people can see. But in actuality, there is no suit. When the emperor parades around town naked, the citizens are afraid to say they don't see a suit, since that would mark them as unintelligent. This goes on unchecked until a young boy steps out of the crowd and, in his naivete, points out that the emperor has no clothes. The lesson? Most people would rather go along with a shared delusion that's making investors buckets of money than say something to the contrary and appear to be dummies. And that's what's going on now with the AI stocks, and it's what was happening in 1999 with the internet stocks. Howard offers 3 guiding principles for investors to help you avoid speculative bubbles that he himself used in his early brush with a bubble back in the 1970s. Number 1, it's not what you buy, it's what you pay that counts. Number 2, good investing doesn't come from buying good things, but from buying things well. And number 3, there's no asset so good that it can't become overpriced and thus dangerous. And then there are a few assets that are so bad that they can't get cheap enough to be a bargain. Because that's the thing about bubbles and periods of overwhelming speculation. The difficult thing, as Howard notes, is that there is usually a grain of truth that underlies every mania and bubble. It just gets taken too far. For example, in 1999, the rhetoric was correct. The internet would go on to change the world. It's the most important technology of our time. And as we speak, I think most people will agree that artificial intelligence will be the next giant leap forward in technology. But the fact that the internet would be the next big thing back in 1999 didn't stop the vast majority of internet stocks soon being worthless. Despite every family in the Western world today owning a car, it didn't stop almost all auto manufacturers from going bankrupt. And that's the problem we face today. Investors have already decided that these 7 large tech stocks will be the big beneficiaries of this AI age. But the problem is, none of these software companies see any profit from AI at the moment. The only one that right now does generate profit from the AI revolution is Nvidia. And that's because they're the ones selling the hardware that the others are buying. But that's not to say that everyone should sell their stock portfolios and run for the hills. In fact, history tells us it's a very bad strategy to get out of the market simply because you feel like a crash might be coming. even back in 1999, despite Warren Buffett kind of picking the dot-com bubble, he still said this, quote, "I want to make one thing clear going in. Though I will be talking about the level of the market, I will not be predicting its next moves. At Berkshire, we focus almost exclusively on the valuations of individual companies, looking only to a very limited extent at the valuation of the overall market. Even then, valuing the market has nothing to do with where it's going to go next week or next month or next year, a line of thought we never get into. The fact is that markets behave in ways sometimes for a very long stretch that are not linked to value. Sooner or later though, value counts. So what I'm going to be saying, assuming it's correct, will have implications for the long-term results to be realized by American stockholders. Because that's the thing with the stock market. They say in the short term, the stock market is a voting machine, and in the long run, it's a weighing machine. Meaning in the short term, the stock prices move based on what people think, but in the long run, prices even out to reality. It's this very notion that bursts most bubbles. Valuations will commonly be bid up way past current performance. We can see that today with Nvidia and Tesla's monster 50 and 183 price to earnings ratios. But all this means is that investors are buying in ahead of time and are willing to wait for the earnings to play catch up, at which time the earnings multiple should right itself thanks to the denominator increasing. But as soon as this phenomenon happens in a stock, it kind of starts a ticking time bomb of investor patience. Maybe that patience lasts months, maybe it lasts years, but one thing is for certain, if the earnings don't rise enough in the time frame that investors expect, share prices do get re-rated accordingly. Marx actually uses Nvidia as an example in his most recent memo, saying that their high multiple today highlights three things. First, that investors think Nvidia will be in business for decades to come. Second, that its profits will grow throughout those decades. And third, that it won't be supplanted by competitors. In other words, investors are assuming Nvidia will demonstrate persistence. But persistence isn't easily achieved, especially in high-tech fields where new technologies can arise and new competitors can leapfrog incumbents. It's worth noting, for example, that only half of the Nifty 50 are in the S&P 500 today. Only 6 of the top 20 S&P 500 companies remain on the list from 2000 to the start of 2024. And of the Magnificent Seven, only Microsoft was in the top 20 24 years ago. This is why Warren Buffett back in 1999 made no short-term predictions, but was able to guess the long-term trend of the market. Mark Twain famously said, "History doesn't repeat itself, but it often rhymes." And that's exactly what Buffett was noting in 1999, and it's exactly what Marx is explaining today. These investors will never be caught predicting that we're looking down the barrel of a 50% crash once again, but they are wise enough to notice the psychological patterns reoccurring in the market today. A shiny new thing, irrational exuberance, FOMO everywhere, and a consensus that for some stocks, there's no price too high. So to answer the question, are we looking at 1999 again in 2025? I hope this video shows that the answer is yes in many ways, but at the same time, that doesn't necessarily mean the outcome will be exactly the same too. So with that said, what's the actionable takeaway for investors trying their best to stay rational at times like this? Well, as Warren Buffett says in his 1999 article, I won't dwell on other glamorous businesses that dramatically changed our lives, but concurrently failed to deliver rewards to US investors, the manufacture of radios and televisions, for example, but I will draw a lesson from these businesses. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide sustainable moats around them are the ones that deliver rewards to investors. And that stays true in all market conditions, as long as you're in it for the long run. But with that said, guys, thanks very much for watching. If you're interested in learning the step-by-step approach of Warren Buffett himself, talking through financial statements, 3 different valuation methods, and a whole lot more, definitely check out Introduction to Stock Analysis over on New Money Education. The link for that is in the description, and it's also a really great way to financially support the channel, so we really appreciate it. But apart from that, guys, thanks very much for watching, and I'll see you all in the next video.